Good day, fellow investors. I continue with my overview of the stocks I research as suggestion from my research platform subscribers, and on this list we have about 15 European stocks, a little bit more maybe, that I have taken a look at, and I'm happy to share here the content. I hope you enjoyed the 10 US stocks. There will be plenty more as there are many suggestions, so let's immediately start with Scandinavian tobacco. So Michael here suggests Scandinavian tobacco, good balance sheet, free cash flows and strong brands, attractive price earnings and price to book ratios with a 40% margin according to Guru Focus. And the guidance is stable, good margins, strong free cash flow. This is traded on the Danish stock exchange, I think. Good earnings per share, so nothing wrong there. But for me, it is still a declining trend. I prefer investing with a tailwind, which, as Warren Buffett says, makes even the mistakes smaller and easier to suggest. Maybe this will be a stable business for the next years, but if they need to use the free cash flow to make acquisitions, to keep the business stable or growing a little bit, or to at least show that that is going on, that's simply not something for me. You see here, before special items, acquisitions, before special items, before acquisitions, but that is also a cost and likely a nature of the business as they acquire the smaller brands, etc. Next one, Ronnie asks, Norway farming salmon, so companies like MOWI, Salmon, Leroy, important source for omega-3 and protein. Moat is very strong because new permits for fish farms in Norwegian fjords are very difficult to obtain. To keep the fjords clean, increasing demand and stable supply can equate to a good outcome for us investors. And if we look at MOWI, you can see that there is volatility. There have been two big drops, of course, the pandemic drop, and then recently the Norwegian government increased the tax on these natural resources, and that is what hit all the stocks and all the sectors. They will likely survive, but when you make extra profits in Norway, like the oil business, I think the taxes there on profits are 74%, which is insane. So that's a risk, but that is also then likely priced in this drop, which makes it a complex government-related politics, clean fjords issue. Then, of course, also as they look at the value of the sold items, biology, net profit on what they make, on the biomass they have, earnings also drop, but still, if you look at where we are now, P ratio of 8, and then if you adjust on average earnings, because you can see these earnings go up and down and up, and then with the taxes on higher earnings will be a little bit down, but on the average cyclical earnings you are more closer to 20, so not that cheap. But still, yes, they are the leading seafood company, largest producer of Atlantic salmon. Nothing wrong with the business. They are slowly and steadily increasing depending on the prices, but they look for increased production, stable, relatively stable EBIT. Of course, this was a drop due to less tourism, cruises, and everyone that consumes that things. So interesting, maximum EBIT recently, but the margins there are good gross margins, 40% and above. Of course, it depends on the price of salmon, but nothing wrong with those margins. And here is the demand-supply discrepancy, where demand growth is expected to continue pretty high at 7, 10, 11% depending on where you look, and supply, according to their calculations, it will remain stable growth at 2%. With such a situation, prices might spike, and then even if the taxes are a little bit higher in Norway, all these businesses should make a lot of money. Then also these businesses do diversify. So of course Norway is good, but now we have taxes there. However, Faroes and other still can make good profits per kilo. Scotland, Canada, and Chile are not as profitable yet, but maybe they will become more profitable. They are paying a dividend. Harvest volumes, of course in winter, a little bit less, but okay. And profits pretty stable. And when you look at those earnings, you also have to adjust for biomass value depending on prices of the market, because they price those in the balance sheet according to what they expect they will get. You can never know what will the price of this fish be when it's grown, but that is accounting, so that's also something to take into account. And here you can see the net fair value adjustment on biomass. One quarter they lose 100 million, one quarter as prices go up they make money, so that is something that skews this at the end, and you never know. You should look at the real cash flows. And if I look at the cash flow covers the dividend, so also the dividends are volatile there, but in line with the volatility of the cash flows. So depending on the price there, maybe they will keep paying the dividend. If there is growth ahead, then they make a good return. But for now, 5%. So, okay business, everything okay. Food, maybe more stable than others, but nothing really spectacular. So, also Leroy, strong revenue growth. This is really something spectacular, 12%. Return on capital employed for them, they say 17%, but even the maintenance of these things is not cheap. So you can see the capex is higher, much higher than the growth. So a costly business, however you look at it, and therefore, okay, nothing spectacular. They are diversifying, of course, to avoid those taxes. They want to grow more as much as they can, improve profits per kilo produced, but again, they have also been hit with the taxes. They are canceling 10% of shares through to a subsidiary transaction. Nothing wrong with that. And this is now the effective tax rate. I don't know what they voted, 25 or 35%, or they first wanted 40%. And that hits, of course, the companies, and that uncertainty is also a key thing. So relatively speaking, these companies are cheap compared to the other things that are there, and nothing wrong with it. If you want to own something like that, of course, now it's a better time to buy than it was in the past. For me, too much government, too much issues, too much unclean fjords. So I'm just personally not interested, even if it looks nothing wrong with it. Now, David suggests Italmobiliare, so good management, a healthy balance sheet, and nice track record. And Italmobiliare is a holding company that buys and sells these industrial businesses in Italy. The stock has been pretty volatile over the last 30 and more years, but this is again an industrial, and you can see that not huge values has been created. Yes, from here when Italian industrials were in the doldrums and now here are much better, yes, but then again, wait for a crisis in Europe and a recession to buy industrials. Anyway, market cap 1 billion, there is a 3% dividend yield. The stock is a little bit down, so let's see the opportunity and how to value this. They are an investment holding owned by a family, nothing wrong with that, listed, dividend yield. So when it comes to such things, they look at the net asset value and then they say our net asset value is 2 billion, our market cap is 1 billion, and there is a 50% discount on Italmobiliare. However, when they calculate those discounts, they say their portfolio companies are valued at 1.2 billion. And then I'm thinking, okay, that's what you say, according to someone that you paid told you. Of course, the higher the price you can get on the estimation, that's the person you will pay for. So when it comes to these holdings, I prefer go and look, okay, these are the companies they own, And then you look, okay, how much money do these companies own? Then you dig into the annual report and you say, okay, what are they making? How many billions do they need to make, millions, to justify the valuation? I have looked at their companies, so looked at the dividends that the holding is getting from Caffè Bordone, Technica Group, AGN Energia, Italgen, and what I have found is that I have 30 million of average dividends coming in per year. And for a good investment, that it is good, I would say, okay, if the dividend yield is 6%, that's a great deal. Thus, in my eyes, the portfolio is not worth 1.3, it's worth 500 million. And there is the discount of 1 billion between the stated net asset value and the real value for long-term value investors. So, okay, business, but nothing spectacular. Now, just a general comment here on French stocks. Antoine says, have you ever looked into French stocks? There is a lot of caps with international business that could benefit from the Asian BRICS transformation in the long term. Okay, nothing wrong with that. And I'm sure that you can find some businesses in France that will be great investments. And maybe one day I will look at the French market, but this is too general as something. All businesses in the world, if doing well, will benefit from that transformation. Just think of Apple and the number of iPhones sold in China from the transformation in China. Yes, Apple benefited. Nokia didn't. So that's a huge question, difficult question to answer, to know who will benefit from such a generalistic trend. All businesses, very hard that will benefit, because there is always competition. Maybe one day, likely one day, we will look at the whole list of French stocks and then maybe find a few to follow, to cover on the research platform, and build the base of knowledge for long-term investing. Arbonia is traded in Switzerland, so it is producing doors, and that's very cyclical, no matter what are the projections for demand for house doors on the German market. So they think the German market will grow in retail, which will be good for them, but the revenues is down, EBITDA has been going down significantly, so there is not crazy demand for doors as it was when people were buying doors and having money. And this is my key concern. Their leverage ratio is just expanding while their numbers are going down. That is a very dangerous situation, because they make acquisitions or I don't know what. But if the market turns against them with such a situation, then it can even be uglier than it looks now. They have great goals to grow 5% per year, to invest, to have 100% cash conversion ratio, to grow the dividend 15% per year. And if they do that, great. But as we have already discussed with a company in the US that we discussed last week, then it's impossible to know what will be the macroeconomic conditions. If the macroeconomic conditions in Germany and door demand change, then all those goals are just that, just goals. And I don't invest in goals that a manager prepared. Too risky. And that also explains the chart here. No value created for 25 years, except for the maybe dividend, crazy volatility depending on the market, that you have no idea what the market will look like tomorrow. And they also go into batteries. Everyone is now promoting batteries in their presentations. We will make so much money on batteries and everything. So yeah, all nice stories to share, but little profitability there. As Mike Tyson used to say, everybody has a plan until they get punched in the head. We did the Porsche Volkswagen video, hope you looked at that. And now we have Ericsson and Nokia, as Maurice suggests. Now, both Ericsson and Nokia has been promising great things as I looked at them over the last 5-6 years. I did look a few times, and they were always promising to make money on that 5G capex boom. That will happen, that will happen. They will make money, better margins, better everything. But they didn't manage to take advantage of that. Neither Ericsson nor Nokia. And then when I look at things, what's going on? Why can't they do and make money? And then there is always the discussion on strategy. What kind of strategy we will apply to make money, to change, reorganization, clearly accountable business group organization. But from a complex matrix organization, no, it's not about that. It's about the advantage you have in the market. You clearly don't have it. Then you first complicate things, then you easy up, and then who knows what, depending on what some investment banker tells you to do, they get their fee and you complicate your life. Maybe you don't have it, you make some money, okay, leave these businesses to pension funds. Maybe this will jump if they make the savings, but when a business is focused on restructuring, savings, etc., it's very difficult that they make money. And if you look at the free cash flow, negative, which means they are not making money, great names, but no distinction there between the market and competition, etc. So hard to invest in. As an individual investor, maybe it will jump 100%, who knows, but I would leave this to pension funds. Now, CBOX Holdings. At first I looked at the company and I couldn't find anything wrong, very interesting, micro cap, small cap, but then eventually I found something wrong. So Giorgio has two stocks to look at because he invested in. We did Park Lawn Corporation in the US video, you can find that in the link in the description below, and then we did CBOX Holdings. And there was also a lot of comments when I analyzed the whole FTSE market about CBOX Holdings, like a cheap, good franchising business, small cap. You can see here they have a good dividend, almost 6%, which is not bad. A small market cap, as Peter Lynch says, that you need to invest in small companies because when those move, you can make 3-4 times your money easily. And if this moves again to where it was before some accounting issues that might not be there at all, then you can make, what is this, 4 times your money pretty fast because the business looks okay. It is a franchise business model. They have been constantly increasing the number of franchised stores, the sales jumping, so nothing wrong. They are operating in the UK. They have been constantly increasing the dividend. That's also nothing wrong with that. Their target is to continue growing the business, double the business ahead. The key performance indicators are good, strong free cash flow conversion. We want those cash flows as investors. And it looks really good, but then again, it's a very small company. 5 to 10 million in profit is not that much, but then there are some issues. So when you look at it, if you want to search it, there was an investigation by a private investor and really amazing work. So you can check it here, and really nice accounting issues and discussing how the auditor resigned because they couldn't see whether the numbers are really there. So everything looks good, a little bit slower. Then I made some calculations whether the stores really can make that money. And if you go to Benthall Green or somewhere else in London, and if you don't see that they sell 20 to 30 cakes in 8 hours, then the numbers are not real. But if you see real traffic and cake sales, especially in out of London, then that's it. You need, with such small caps, you need to do field research and ask maybe the franchisors how that goes. However, there was this investigation that the connections, some things, there were a lot of adjustments in the annual reports year by year, and people are afraid that this might look like patisserie, Valerie, fraud charges. Of course, the owners are also incentivized to show that everything is good to grow, because if things are not good, you don't grow. And then we had also see Luckin Coffee and things like that. So these are very small companies, and only the future will tell you the truth. So yes, it all looks good on the surface. There are some issues that might not even be issues there, but for me it is too small and too crazy to invest, to dig deeper. Check the link, it was a little bit earlier there. Research it, individual investor, CBOX company, read it, and then try to figure it out for yourself. Next one is CTT, Portugal, the postal situation there in Portugal, and all these post stocks look cheap. Dividend yield 3.6%, P ratio of 10, nothing wrong, but the stock has been subdued for a while and it looks like value. But I'm looking at this and then I'm thinking, okay, postal services, Europe, government owned, etc. Better to look at that when there is a crisis. When there is a European crisis, as you can see here, public only here, because it was in a crisis, don't know if there was restructuring or whoever, or the government needed money, so it went public with it. So, these are these legacy old businesses that, yes, they always look cheap, but what will change that cheapness is always the question. And 3.6 in dividend is not enough for me to change that perception, or to hold until this changes. Same question from Manuel about EDP, the electricity there, monopoly in some areas in the country, and you can see here that as interest rates on these monopolies, on these stable utilities, as interest rates go up, the price there suddenly goes down, because you can get similar yields elsewhere, and as there is a chase for yield, the stock price goes up. As the chase for yield vanishes, the stock price goes down. So it is about yields. Can I predict interest rates in the future? I can't. Nothing wrong with these utilities, but you have to check the debt, if there are issues in Portugal, crisis, interest rates on Portuguese treasuries, etc., etc. Nothing spectacular, but nothing also special. Now, Teleperformance, another, I think, Portuguese business, very, very interesting, looks really, really good. And here I'll ask for your help a little bit. I'll ask for more insights, perhaps also from Portuguese people, on the things that are wrong here, because everything looks really, really good. A good business, great, nothing wrong. Of course, some COVID contracts, this is a call center business, are hurt, but the rest all look really good. They make about 1 billion in cash a year, so nothing wrong. Dividend growth, and as that COVID businesses, everything was growing, digitalization boom turned, so did the stock go down. But maybe from the current situation, the stock doesn't deserve that. The only issue is AI, that if they can take advantage of it, it might work for them. But with the development of AI, maybe we will talk to AI and not to a Teleperformance representative discussing the wrong number of shoes that they have sent you when you ordered that. So I looked at the business a little bit, diversified, 410,000 employees, crazy number, they are growing. And okay, a little bit excluding COVID contracts, but also not that crazy, so stable. After the boom they had, of course, in the past, good results, stable revenue, profitable, good operating profits. So for the first year, P ratio around 10, nothing wrong, good diluted earnings per share. First half results very diversified across sectors, digital transformation, so nothing wrong. They boomed in the pandemic, but they have been growing and have been profitable at bat. So that's the great businesses you are always looking for. They're making $1 billion in free cash flows. There is something left for dividends, acquisitions, growth. Really, I cannot find anything wrong with this business. So I'm really looking forward to your comments. And the only thing I could find is AI disruption, because if that happens in the next few years, then you can really get disrupted on these contracts. Someone can do it cheaper, faster, more precise, and more polite than you. Now, the next business is Tessenderlo, which I think is a city in Belgium, but it is an industrial. And again, check the stock prices of these industrials. It is about the dividend. They pay out the dividend in good times, and it is about the stock being there. Now the dividend is very low. So wake me up when this is in the mid-teens in a recession, and then we can look at these industrials if we cannot find anything better. So yes, it has 4 segments, from fertilizer, industrials, machines, etc. But what if all the 4 segments are suddenly in a bad situation? That's also something that adds to the volatility of the stock. For a dividend yield of just 2% and all the investments that they are doing that will lead to volatile cash flows, it is simply not attractive at this price. Platinum, Sylvania Platinum, but this will be about the PGM metals a little bit. Of course, something like this always depends on the price of platinum, that's very simple, or rhodium, or depends on what they are producing more. Here they have done really well, great story, 10x with the stock. They are paying a 10% dividend, but when it comes to platinum, it is used 50% for catalytic converters for cars, trucks, and buses. If there is a recession, less cars, trucks, and buses are demanded, purchased, which means that the price then of platinum futures goes down, and that impacts also their situation. Now I've looked a little bit at the company. They have 4 elements that they calculate in their own price basket. So the basket price is 2,000 for now. They have very low cost of production, but they are, I think, focused more on rhodium, and also rhodium prices have gone down, but they have had great margins, nothing wrong with that, but they have been making a lot of money on rhodium and palladium, and both have fallen. So going forward, they will not be making the same amount of money, so it's not really comparable. And I think rhodium is exclusively used in the car industry, and these numbers are also telling you that the car industry going forward might be shakier than it is, which also explains the Porsche and Volkswagen stock price that we discussed. Of course, if you look at forecasts, those forecasts are all over the place. So somebody is more conservative, somebody is more exuberant. So we have a 4,000 projection for rhodium, 10,000 long term, and that is crazy because these will have huge impact on the valuation of a business like this. For me, when it comes to this, you might want to look at this if it's profitable in a recession, and then sooner or later, if the car industry rebounds, then they make a lot of money. And that is the thing you want to catch, which is possible, but it has to be really, really ugly. There has to be no dividend, not the 10% dividend. That's typical for cyclical. So when dividend is here, minimal, not maximal, then you look at it and then you say, okay, I can survive, or the business can survive 5 years in that bad environment. You buy, and when it rebounds in 2-3 years, you make a lot of money. And that's also perhaps the best way to bet on an automotive rebound after a recession. I've looked a little bit at the cost curve. They say that prices are 50% of the cost curve, but they include capex and maintenance and growth and everything. This is not the cash cost curve, which is the most important. But okay, the business is doing good, cost a little bit going higher because of inflation, and here you can see that free cash flows are going down, will likely return to a little bit normality. And then also it is not as cheap as it looks. They will produce, but they expect an automotive return. Too risky for me to bet on that. Now let's touch a little bit on Eastern Europe. We have DIGI Communication, but this is a telco. I already looked at it. There was a lot of interest in the past. They are doing well in Romania, a little bit less well in Spain, and then they are wanting to expand in Belgium, which costs a lot of money. So the business is mostly Romania, a little bit of Spain, and now there are some growth projections, but it's extremely difficult to grow in those competitive markets. You need to go below price, and you never know whether you can make money. So just for being a Romanian telco business, okay, looks good, nothing wrong with it, but then again, just a telco with Romania, a little bit too risky for me, because I think there is also some debt there. Now we have some companies from the Baltics. Justin suggests Grigeo and Linas Agro as companies. Then nothing wrong with the companies. P ratio, I think around 10, 12, dividend, paper stock there. So it will depend on the industry in Lithuania. And as always, as these cyclicals, I prefer to find them in a recession, and nothing wrong also with this food company. They did really well as food prices exploded. Maybe it will return to some normality here, but they are investing, likely benefiting also from the closure of Russia, which was always a producer there, so that's a positive. So maybe flattening out revenues. If they flatten, then again you have a P ratio of 10 business, and that looks like something that is there in the Baltics, Eastern Europe. We discussed MOWI, P ratio of 10, 4-5% dividend. Really nothing wrong there. So if it fits to own you, if you know a little bit the local situation there, or with MOWI that we made a video for Poland, then why not? I mean, in the end, it's to own something, enjoy the ownership of the business, but I'm really not a specialist on the Baltics, on Poland, so not my cup of tea, as they would say. Also, not my cup of tea are Semis, casino software. So Roberto asks about some of them, but really too crazy to understand those casino software producers, how that works, how they make money. So those might be interesting, but a little bit too complex. Thanks for watching. Check my research platform, and I'll see you in the next video.